everybody. I'm Jessica McClellan with William Vaughan Company, and today I have with us Bob Bradshaw, a partner in our tax department, who's here to talk to us about 174 research expenditures. Hey, Bob, how are you?
Hey, Jess, thanks so much for having me. You know how much I love talking tax.
Yeah, I really appreciate you jumping on here this afternoon. Could you tell us a little about the 174 R&E and where we've been and kind of how this came about?
Yeah, certainly, Jess. So basically, most of us don't even know what 174 is, mainly because it's been in the code section since 1954, and it's basically said that anything that's qualifying R&E expenditures, basically we're allowed to immediately expense them. So since 2000 or 1954 all the way to 2021, we've been able to immediately expense these research expenditures. We haven't had to try to figure out, is it a trade or business or is it a research expenditure? Didn't matter for all intents and purpose because we are able to get to the same exact result immediately expensing it. Well, in 2018, most of us know about that tax reform, commonly referred to as TCJA, or the Tax Cuts and Jobs Act. In that bill that got passed, the only way they were able to actually get it across the finish line with all the certain cuts that they wanted were to do some sort of revenue generators to keep it within the parameters that were set out by Congress. So one of those parameters being is this 174 that started in 2022. We now have to capitalize and amortize those costs. So no one had thought that would ever happen. Congress had completely had support on both sides of the aisles and thought that by the time 22 came around, we would have this fixed and they would have punted this at least down the road to 2026 being the year that almost all the other provisions in their sunset or expire. So that's kind of the background on
So where are we today, Bob, with this
it.
legislation?
Yeah, so obviously we're having this conversation, so it's not a good thing that we're having this conversation for many of the taxpayers, especially in Northwest Ohio and across the Rust Belt, because this hits manufacturers pretty hard. We have not got it passed or fixed. They had about 3 or 4 different times last year in the bills, they being Congress. They had it, the fix in the bills. The biggest one being the last bill that got passed December 27th, the omnibus bill, that kind of had a lot of language in there, even the Secure Act 2.0. This was in there, and then they just didn't get it into the signed draft. We're not exactly sure why it wasn't. Mainly what we're hearing from the Congress, our constituents, is that it relates to the Democrats wanting to get the child tax credit. So they were trying to get this both sides of it. Well, we didn't see that. So that means as we're sitting here today, Jessica, we have to file our 2022 tax returns that are due here very shortly with this capitalization and amortization of 174.
So it sounds like a lot of people, individuals, and businesses are now going to be impacted by this. So our clients are facing, a difficult decision. So how are you advising our clients how they proceed without, determined legislation?
Yeah, that's a great question, Jessica, because as I mentioned, they have bipartisan support. So Congress is still saying that June, July, August timeframe, they're going to fix this. They're going to go back and make this retroactive, which is not unheard of. They did that with the QIP glitch a few years back. So there is support out there on both sides of the aisle to get this fixed. Well, unfortunately, June, July, August is after your tax payments are due. April 15th is when when an individual has to pay their tax estimates or taxes due along with first quarter estimate. And even if you were to file an extension, it doesn't extend the time to pay. It only extends the time to file. So what we're trying to do is sit down with our clients and just make them aware of, hey, this is your potential liability. It's going to be massive. And we're probably recommending each one to be a little bit different. How aggressive are you, and how confident are you in our Congress? So between those two things, and then the calculation of interest and penalties, say this never does get fixed, it's about a 9% delta. So are there other avenues for us to pay that and not get hurt with a 9% over the next few months? There's so many variables that go into this. It's like I said, it's not fun to have those conversations, but they're real conversations that need to happen now.
So Bob, you gave an example of like $1 million. Could you go through that example again, just to give our
Yeah.
audience a view of what the sizable amount that is?
Yeah. So if we're thinking about this, if we're going to look at 21 verse 22, and let's assume all facts stay the exact same, and we had $1 million of research expenditures, which is not a high number for a lot of manufacturing clients, because again, this is just the creating new and incentive ways to run your business. You're doing that every single day. So a lot of you guys are probably already hitting that $1 million threshold, if not way above that. But a million is easy to use because I don't have Excel in front of me. So we're going to go ahead and use that million. So you have to capitalize and amortize those costs over a 5-year period, with the first year being a half life. What does that mean in round numbers? That means that I got $1 million in 21 that I was able to deduct. I'm only allowed to deduct $100,000 this year, with that remaining 900,000 to be deducted ratably over the next 5 years upon that. So those people that were breaking even are going to now, if you run the math on that $900,000 of income that you have to pick up because you didn't get those deductions, you're going to have to pay somewhere around $333,000 of tax on that. So year over year, nothing has changed except Congress did not fix this. You're out of pocket, like I said, $333,000.
Wow, that's a big chunk of money. So Bob, I really appreciate you joining us. Final thing, if you had someone that doesn't have an account or has an accountant and hasn't discussed this with them, what would you advise them to do?
I would recommend them either contacting a CPA who does, myself, or anyone else who has experienced this, or even the firms that even specialize in this. If you're not addressing this or looking at it, this could really, really whipsaw you, because again, these are large dollar amounts. It's a timing difference at the end of the day, right? Because after some point in time, these deductions are going to phase themselves in. But the Congress can go back, or not Congress, the IRS can obviously go back and audit you, and those substantial underreporting penalties are quite huge. So you definitely need to be thinking about this and how you're going to be attacking this come April 15th.
Well, Bob, thank you so much. We really
Yeah.
appreciate all of your insights. And I know you definitely like to talk tax code. So thanks for jumping on here, and hope everybody has a great day.